Welcome to the Options Trading Podcast. We're on a mission to empower individual investors with the knowledge they need. Join us as we break down complex topics into simple, step-by-step guidance for conservative options trading.
Have you ever looked at a really high-flying stock like Amazon, maybe Tesla?
Uh-huh. The big ones.
Right. And you think about trading options on them, but then you immediately hit this mental wall.
Thinking you need a fortune.
Yeah, I must need like tens of thousands because I've got to own the stock or at least have enough cash for 100 shares idea.
Mm-hmm. That exact thought.
Well, that assumption, that sort of automatic roadblock, that's the myth we're really digging into today.
Yeah.
It stops so many people before they even start.
And let's just be super clear right from the jump. That is completely false.
Okay, good to hear.
You absolutely do not need to own the underlying stock.
Yeah.
And you don't need the cash to buy 100 shares of it just to trade its options.
Wow.
It's a really fundamental misunderstanding, and it's high time we cleared it up.
Okay. That's probably a massive relief for a lot of people listening. But, I mean, it raises a big question then, doesn't it?
Where did it come from?
Yeah. If we don't need that huge pile of cash or the actual stock, where did this whole 100 shares thing even start?
Right.
And maybe more importantly, how does options trading really work for the average person if they're not buying and selling the actual stock like the myth suggests?
Well, that is precisely what we're going to unpack right now.
Okay.
Our mission for this deep dive is really to break down how options actually work, trace back where this common myth came from.
Find the source.
Exactly. Pinpoint its origin, and then show what you genuinely need to trade options.
Right.
And hopefully highlight just how accessible and, frankly, how flexible options can be for almost anyone.
All right, let's get into it then. This 100-share rule idea. Where does it actually stem from? What our research pointed to is that standard U.S. options contracts, they represent 100 shares.
That's the key word, represent. It's not that you need them right away.
Okay, so that's where the confusion starts. It's linked to what happens if you exercise the option.
Exactly. If you actually go through with using the option to buy the stock or sell it,
then the 100 shares come into play.
Then yes, you either need the 100 shares to deliver if you sold a call and got assigned, or you need the cash to buy the 100 shares if you exercised a call.
But, and this seems like the big but.
It is. Here's the thing. Most options traders, probably the vast majority, they never exercise their options.
Never. Okay.
Well, rarely. It's just not the main goal for most people. This is really crucial to understanding how options usually work in practice.
So they're not trying to become stockholders through options?
Generally, no. Most people are in it to trade the contracts themselves.
Oh, okay.
You just buy an option contract at one price.
Hoping it goes up.
Right. And then you sell that same contract later, hopefully, like you said, at a higher price.
So the profit or loss is purely on the contract's price movement.
Exactly. It comes directly from the change in the options premium. It's market price. It's usually got nothing to do with actually owning the underlying stock.
Which means that whole 100 shares barrier.
It's just not relevant for the way most people trade options. It allows for really capital efficient strategies. You can sort of control a large block of shares
without putting up all the money for them.
Precisely. A fraction of the capital needed to buy the stock outright. And that can amplify your potential percentage returns or losses, of course.
Right. Risk is always there. But that distinction is huge, focusing on the contract's value. So, okay, let's get practical. What does someone actually need then to, say, open an account or place a basic trade? People worry their broker won't let them if they don't have the cash for 100 shares.
Yeah, and that's another layer of the myth. Most brokers will let you trade options without owning the stock or having that big chunk of cash ready.
Okay.
What you actually need, it really depends entirely on the specific type of options trade you want to make.
So give us an example, like just buying a call.
Okay, yeah. If you're just buying a simple call option that gives you the right, remember, not the obligation, to buy the stock at a set price.
Or a put option, the right to sell.
Right, or a put. If you're just buying either of those, all you need is enough money in your account to pay the premium.
The price of the option contract itself.
That's it. Just the cost of that contract. It could be, relatively small depending on the option.
So maybe a few $100s, not tens of thousands.
Often, yes. Now, it gets different with other strategies. If you sell a covered call.
Covered meaning you do own the stock.
Exactly. Then yes, you do need to own those 100 shares because you're promising to sell them if the buyer exercises the call.
Makes sense. You need the goods to deliver.
Right. And if you sell a naked put naked, meaning you don't own the stock.
Oh.
Well, that usually requires a margin account, and you need to have sufficient collateral set aside. Because if the put buyer exercises it, you might be forced to buy 100 shares at the strike price.
So the broker wants to know you can cover that potential obligation.
Correct.
Most investors are told to accept risk, ride the market, and cross their fingers. But what if you could beat the market while spending less than 2 hours per month on your trades? That's exactly what you'll learn in a free training at weloveoptions.com/passive trading. You'll discover a proven low-risk trading strategy, a simple way to find winning stocks without research overload, how to stay profitable without daily screen time. Plus, you'll get a bonus, the synthetic annuity, showing how to earn cash flow even from losing positions. Go to weloveoptions.com/passive trading and register your spot now.
But these are specific strategies, often more advanced. They're not some universal requirement you need just to buy your first call or put option.
Got it. So it's not a flat rule. It really depends on what you're trying to do. That opens things up quite a bit. Okay, what about expiration? If you hold an option right until the end, our sources warned about this, saying if it's in the money and you just let it sit.
Ah, yes. Automatic exercise.
That's where the 100 shares or the cash might suddenly become very relevant, right?
Absolutely spot on. If you're holding, say, a call option, and at the moment of expiration, it's in the money, meaning the stock price is above your strike price.
So it's profitable to exercise it.
Right. If you haven't actively closed out your position, sold the contract, your broker might automatically exercise it for you.
And boom, you're obligated to buy 100 shares.
Yep. You'd need the cash in your account to cover that purchase. The same sort of thing happens with an in-the-money put option. You could be obligated to sell 100 shares, which might mean your broker has to buy them first if you don't own them, creating a short position.
And if you sold the option originally,
then you could get assigned. If you sold a call, you might have to sell your shares. If you sold a put, you might have to buy shares.
which sounds like something you'd want to avoid unless you planned for it.
Precisely. And that's why most experienced options traders are very careful about expiration. They almost always close out their positions before the expiration bell rings.
Sell the contract back to the market.
Exactly. Unless they have a very specific, intentional reason to want the option exercised or assigned.
It just keeps things simpler, avoids surprises.
Simpler, avoid surprise obligations, and often, honestly, it just makes better financial sense from a strategic standpoint to capture the remaining value in the options premium rather than deal with the stock transaction itself.
Which really loops back to what you said earlier.
Yeah.
The main reason most traders don't exercise is it's often not the most profitable way.
Generally, yeah. Think about it. You buy a call, the stock goes up, great. Your options value, the premium, also goes up. You could exercise it, buy the 100 shares at the lower strike price, then immediately sell those shares at the higher market price for a profit. But that involves more steps, more capital.
And potentially commissions, fees.
All that. Or, as the source material makes clear, you could just sell the valuable option contract itself directly back into the market.
Take the profit on the contract.
Bingo. No need to handle the stock. No need for the large sum of money to buy 100 shares. It's just pure contract trading. You're leveraging the option to profit from the stock's move without touching the stock.
That leverage point seems key.
It absolutely is. The vast majority of profits and losses in options trading come from buying low and selling high on the contracts. That's the real power here.
So much flexibility.
Immense leverage and flexibility, controlling effectively a large number of shares without actually owning them.
So let's bring this home for everyone listening. What does this all really boil down to?
Well, first and foremost, that idea, that really sticky notion that you need to own 100 shares or have the cash for them just to trade options.
Yeah.
It's definitively a myth.
Just flat out wrong.
Flat out wrong for most common ways people trade options. And it's a real shame because that misconception genuinely stops people from even looking into what could be a really useful financial tool.
Yeah, it gatekeeps unnecessarily.
It really does.
Yeah.
Because options, when used properly, offer that incredible leverage and flexibility we talked about, controlling shares without the huge capital outlay of ownership.
And you mentioned something interesting earlier. It's getting even more accessible.
Oh, yeah, that's a really exciting development.
According to the CBOE, there are over 3,700 optionable stocks out there, but not all of them are worth trading. What most new options traders do not realize is that choosing the right stock is 50% of the battle. That's why we created my Ultimate Watch List, a free list of the top 144 stocks for options traders. Every stock passed multiple tests for liquidity, volume, strike depth, and premium quality. Get it now free at weloveoptions.com/stockslist. It's our personal list, and now it can be yours.
And you mentioned something interesting earlier. It's getting even more accessible.
Oh, yeah, that's a really exciting development. We're starting to see, for some stocks anyway, the rollout of mini contracts.
Nice. What are those?
Instead of representing 100 shares, they represent just 10 shares of the underlying stock.
Oh, wow. Okay, so the premiums would be much lower.
Exactly. It makes getting started with options potentially even more affordable, opening the door to a much wider range of people. Imagine the possibilities that unlocks.
That really reinforces the point from our deep dive.
Yeah.
Then options trading isn't some exclusive club for the super wealthy.
Not at all. If you learn the ropes, it's actually one of the most accessible, versatile, and powerful trading tools out there.
So for listeners who are thinking, okay, maybe this is for me, what are the practical first steps, the key takeaways?
Right. Actionable advice. Number 1, start small, really small.
Don't bet the farm.
Definitely not. Number 2, prioritize learning the rules. Understand the strategy you're using, the risks involved, how expiration works.
Education first.
Absolutely. Use a virtual or paper trading account if your broker offers one. Practice. Build confidence before you put real money on the line.
Good call.
And crucially, remember the main point. Focus on trading the contracts. Don't get fixated on owning the stock unless that's part of a specific deliberate strategy like a covered call.
Trade the premium, not the shares.
Mostly, yes. And always manage your positions responsibly. That usually means closing them out before expiration unless you specifically want them to be automatically exercised or assigned. Don't let expirations sneak up on you.
Solid advice. So thinking bigger picture now. If options offer this kind of, let's call it financial freedom, letting you control assets without direct ownership. It kind of makes you wonder, doesn't it? What other barriers, maybe ones we just assume are there, might be holding you back in your own financial journey?
Interesting thought.
And what other strategies, what new possibilities might be waiting just beyond those first few steps into a world like options trading? Something to think about.
This is an AI podcast based on educational material from Option Genius. Visit us today at optiongenius.com.